We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Adam Hamilton, founder of Zeal LLC.com. Thanks for joining me today, Adam.
Hey, Tom, it's an honor to be here. Thank you so much for having me.
Great to have you. And, I recently came across one of your articles entitled Gold Thrives in Rate Hike Cycles. And I thought it would be, a really great way to help us give some perspective to our audience on how these cycles affect gold. So, when we think about rates rising, that creates competition for gold in theory, because the yield on the US dollar bonds becomes more attractive than gold that technically yields nothing. So why do you think that this might be kind of a flawed way of thinking about the situation?
Well, Tom, that's a great question. And I had this conundrum many years ago. I started this research, I don't know, when the last rate hike cycle started. I guess that was back leading into December 2015. I'm a speculator. I speculate in gold stocks and sometimes gold. And I was noticing that every time something came out that was considered Fed hawkish, it could be an economic report, it could be some Fed speak from a top Fed official, a Federal Open Market Committee meeting, that the gold futures speculators would rush to sell gold. They just hammer it hard. I mean, we had days when gold was down, 2-3% within 24 hours, and just it didn't make a lot of sense to me. Like just the huge sensitivity of gold interest rates. I hear you on the bond thing. Bonds yield more. They're competition for gold, as you said. But I wondered if there was a really historical basis for dumping gold that hard whenever something Fed hawkish came across the wire. It seemed really overdone to me at the time. And so that's how I started the research back in, I think, late 2015.
So when we think about these rate hiking cycles, maybe explain to us a little bit more about the mechanism of the thinking around how these speculators are dumping gold when the Fed gets hawkish.
Well, gold futures is a super hyper crazy leverage game. I mean, I'm just amazed it's even legal. I'm sure you've heard about the spoofing cases that have been tried against like JP Morgan traders at some other big banks. They've been convicted of spoofing, which is putting in false sell orders really fast with a computer and then withdrawing the sell orders before they're executed. That hammers the gold price sharply lower. And the reason that works is because of the crazy leverage. The last time I checked, Tom, last week, the required minimum margin to have in your account per gold futures contract traded in the US COMEX was $7,200. But if gold's $1,850, each one of those contracts for 100 troy ounces is worth $185,000. So it's like 25x to 30x leverage they allow through gold futures trading on the US markets. And that's crazy. Now, if you're running at 25 to 30 times leverage, a 2 or 3% drop in the gold price is a huge deal because you have 2 to 3% times 25 or 30 losses if you're wrong in this trade, if gold moves against your positions. Mm-hmm. And so these gold futures speculators, they have to have like an ultra myopic short-term focus. They can't think in terms of months like a gold stock speculator might, or years like an investor might. I mean, they're thinking about hours or days or maybe weeks if they're really long-term gold futures speculator. And so when something Fed hawkish comes across the wire, their problem is they have to decide how they're going to trade it right now. I mean, they're running 20, 30 times losses. And so what happens is they queue off the US dollar. The main metric for the US dollar, the main benchmark is the US dollar index, USDX, Dixie, some traders call it in the US. Mm-hmm. And when something Fed hawkish crosses the wire, the US dollar index shoots up fast. I don't know if the Canadian dollar is sold off. I haven't really looked at the Canadian dollar relative to the US dollar. I assume it is when the US dollar rallies. Mm-hmm. But so the gold future speculators, they're watching the US dollar for their primary trading cue. So the dollar rallies off Fed hawkishness, and the dollar rallying on higher potential yields makes sense. I mean, yield differentials, interest rate differentials around the world really affect currency trading without a doubt. And currency itself is a hyper leverage game. I mean, you hear about 100-to-1 leverage in currency markets. That's something I've never traded, so I don't really have any experience with currencies. But when you're running that high leverage and the dollar's moving and you're taking 25 to 30 times losses on your gold futures, if you're wrong, you just got to trade instantly on the dollar movement. And so the Fed's affecting the dollar. The gold futures speculators, because of the myopic focus and crazy leverage, they're watching the dollar and dumping gold futures in response. So it's kind of an indirect relationship, as near as I can tell.
So when we see the Fed come out and posture very hawkishly like this, we see stocks really sell off, like the general equities as well. So do you see that mechanism come in where the average speculator in the general equities is selling stocks to buy US dollars in essence, or to trade for US dollars? Does that drive the dollar higher as well?
Yes, in a sense, there's definitely safe haven buying of the dollar. Like when the stock markets fall materially means just to generate enough fear. It could be like 1.5%, 2% a day on the S&P 500. People rush to the dollar, they rush to cash. And so there's definite safe haven buying. And if the Fed shocks traders enough, if the news is hawkish enough, surprisingly hawkish enough, like more hawkish than traders expected, then the stock markets will fall fairly hard. And that spawns dollar safe haven buying. A primal example of that was during the March 2020 stock panic on the pandemic lockdown fears. You remember that COVID-19, no one knew how bad it was at the time. And so the government's trying to figure out, what do we do? Do we stop the spread of this? What's the lethality? Or what percent of people are going to die who get this virus? And so the stock markets fell like 35% in the US, like in less than a month or something. S&P 500, really hard, fast fall. And the dollar index just went vertical in that. I think like maybe 8.5%, 9%, Tom, if memory serves. And that was within a couple of weeks. And that just slammed gold sharply lower. But so the stock markets affect the dollar in the sense of safe haven capital flows, flight capital exiting, fast falling stock markets, generating enough fear to be meaningful.
So getting back to the article here and kind of the reason for our conversation today, how many rate hiking cycles do we have to analyze since 1971? And how do you define a rate hiking cycle?
Great question. I picked 1971 in this research all those years ago, Tom, because obviously Richard Nixon severed the US dollar from the gold standard, I think August 1971. And so that's the era when the dollar is just free floating, totally fiat, backed by nothing but the full faith and credit of the US government. And so pre-gold standard days, I haven't looked before 1971, but since 1971, there have been a dozen rate hike cycles before today's, which is the 13th modern rate hike cycle. I define a rate hike cycle as 3 or more rate hikes with no intervening cut. There's been like a half dozen times in that span where the Fed has hiked once and then gone back to cutting right away. There's been another 6 times where the Fed has hiked twice and gone back to cutting. So rate hike cycle, 3 or more consecutive hikes with no intervening cuts, regardless of the time span.
So when we analyze the data for all of those dozen rate hiking cycles, in how many of those did gold perform positively?
So out of those dozen, gold actually rallied through 8 and fell in 4. And that's really important. One thing I studied through this research over the years, Tom, is I was trying to figure out what differences there were. Why would gold rally through some and fall through others? And I found out there were 2 things that seemed to really affect how gold performed through Fed rate hike cycles. Number one, which is really obvious in hindsight, is how high was gold when it entered it. If gold has just gone parabolic, is crazy overbought, it's just had an amazing bull run and it enters a new rate hike cycle, everything that goes up must come down. So when you have a super fast, hard run, things are going to correct no matter what happens. And so if gold enters a rate hike cycle really high, super overbought by the past 1 or 2 year standard, that's going to have a tough time during the rate hike cycle. And the second thing, which maybe, I don't know, was less intuitive to me, but maybe not to your listeners, is how fast and how hard the Fed hikes affects how gold performs. The faster and more aggressive the Fed rate hike cycles, the worse gold performs for them in general. So those are the 2 criteria that seem to affect gold's performance from a macro standpoint.
So what cycle is this era most like to you?
Oh my gosh, that's a great question. I think it's most like the last couple cycles, Tom. Back in the early 1980s, I'm 48. So in the late 1980s, I was a little kid, 5, 6 years old. But I remember my dad, he was in rural banking in North Dakota. I remember him talking about the Fed and inflation and high rates and just how it was affecting his business. He was a principal at a local bank. It's the rate hike cycle today is much more like the last couple, but faster than the late 1970s, early 1980s hiking cycles. They were crazy. So we mentioned those 4 cycles where gold actually lost during Fed rate hike cycles. It fell from the exact date of the first Fed rate hike to the exact date of the last Fed rate hike. The average loss was like 10.5%, Tom. So not huge. I mean, it was material. You wouldn't want to be invested in gold if it's going to fall 10.5% over a couple of years. But those cycles, the average hikes back then were just crazy. I wish I would have been old enough to really pay attention back then. But I mean, we're talking about like 124 basis points per month on average through those four hiking cycles where gold lost on average. So a point and a quarter per month. And right now, the Fed's hiking about 50 basis points per meeting. The Fed chair, Jerome Powell, recently said at the last FOMC meeting in early May that they were looking at 50 basis point hikes the next couple of meetings. And so there's 8 FOMC meetings a year. It's roughly every 6 weeks or so. So we're looking at like a 33, 35 basis point per month right now. And this is a hard and fast rate hike cycle by recent standards. Mm-hmm. The last couple rate hike cycles, they just had quarter point hikes, period. No half point hikes. The last half point hike was back in May 2000. That helped burst the dot-com bubble. So this cycle is faster today than the last couple cycles, but it's way, way, way slower than the 4 through which gold actually lost price through.
Mm-hmm. So if we consider all of these hiking cycles combined with other data like inflation currently being at 40-year highs, is it possible that we have to take inflation into account as well?
I think absolutely, man. Inflation is just hurting people so bad. The Federal Reserve puts out tons of data, and the Fed affects markets so much. I really try to follow the Fed stuff closely. And they have a survey they do of Americans, and they ask people, "Hey, are you living paycheck to paycheck?" And the last survey I saw, I don't remember the date, but something like 78% of Americans, 4/5, said they're living paycheck to paycheck. So the inflation's brutal, and investors see it too. Investors obviously have to have surplus capital by definition. We're really blessed and fortunate to be able to invest and trade stocks. And that implies that we can meet our basic needs. We can afford the inflation. We can afford food, afford energy. Mm-hmm. But investors feel it too. We see how much more expensive it is to fill up our gas tanks, to buy food for our families, to just pay all our bills. And so the higher inflation gets, the more investors look to gold as a refuge. They have the memory of the late 1970s, early 1980s. The global gold supply only grows in the order of 1% annually or less through mining. That's why gold's been the ultimate currency through, at least 6 millennia of human history. And so because gold has a hard limited growth rate geologically, it's just the ultimate currency. And so if the dollar's inflating by 15, 20% a year, the money supply, or I don't know what the Canadian dollar growth rates are, and gold's growing 1% a year, gold's a logical place to move capital for refuge when inflation here. So inflation should boost gold's performance through Fed rate hike cycles without any doubt.
Mm-hmm. So is it possible that the Fed actually forces rates high enough to overcome inflation, do you think?
In my opinion, no, for several reasons. There were 2 inflation super spikes in the 1970s, and gold nearly tripled during the first. It was like 30 months or so into like December 1974, mid 1970s. The second one peaked in early 1980. Gold more than quadrupled during that one. That was 40 months long. But to kill those, Paul Volcker, at the later one at least, he had to raise the federal funds rate above the headline inflation rate. I remember my stories from my dad talking about 18, 19%. He talked about the prime rate back then, but the federal funds rate is underneath that. And so I think inflation peaked about 15% on the CPI back then. The CPI was more honest back then. Today it's really lowballed. There's all kinds of bad decisions that make it look less bad politically. But I think the Fed has to raise the FFR above the headline inflation rate. In the latest monthly report of the CPI in the US was like 8.3% year over year. And I just looked this morning at the dot plot, the Federal Reserve officials' projections for future rates, and they still see a terminal rate, at least in mid-March, of 2.5% for the FFR. You can't fight 8.3, 8.5% inflation with a 2.5% federal funds rate. Just impossible. Mm-hmm. And there's another component to that as well, Tom. I think the primary reason we have inflation today is not the zero interest rate policy. I think it's the Fed's crazy money printing since that March 2020 stock panic. Between right before that started in mid-April this year, the Fed ballooned the U.S. money supply by 115%. Its balance sheet is the monetary base underneath which U.S. dollars are spawned, created out of thin air. And so we're talking about 4.8 trillion, more than doubling the Fed's balance sheet. And that's why the inflation is here. All that new money was spewed into the system. And of course, goods and services to spend money on didn't grow anywhere near 115% in 2 years. And so I think the Fed has to remove at least the majority of that QE4 money printing. So we're talking about $2.5 trillion ish of QE plus a federal funds rate above the headline inflation rate to stop this. I just don't see that coming. That would just crash, collapse, destroy the stock markets, and probably push the economy into severe recession, if not depression.
Mm-hmm. Well, and just from a debt servicing standpoint, each percentage or 100 basis point move that the Fed hikes, I believe it's $300 billion more just to service the debt every year, right? So, those numbers just sound so crazy to think about when you consider the relative size of just servicing the debt, never mind actually trying to pay any of it down, right?
Absolutely. Yeah, it would bankrupt the U.S. government. Is like $30 trillion now, the U.S. national debt, somewhere close to there. Also corporations, that's another problem. Corporations borrowed hundreds of billions, if not trillions of dollars to buy back their stocks since 2008, when the Fed first went to its zero interest rate policy. So corporations have huge amount of debt in their balance sheets, and they won't borrow to buy back stocks if they're paying too high of interest expenses on their existing debt. Same with residential, just normal Americans, Canadians. A lot of people pretty much everybody has mortgages, and a lot of people borrowed on home equity lines. And they're going to see their costs go up as well, and that slows down spending. The slower the spending is, less corporations sell, the less profits they make, which pushes their valuations and price to earnings ratio terms even higher. And so, yeah, higher interest rates just slow the economy so hard and fast. And the Fed does risk bankrupting the U.S. government, probably not corporations, but certainly the U.S. consumers who are heavily indebted, probably Canadian consumers as well, if Canada rates follow U.S. rates. Mm-hmm. It's ugly, man. It's scary.
Well, I know last week in Canada, we saw another 0.5 point hike from the Canadian central bank. So I don't know what our relative level is. It's been a while since I've looked at it, but I think we're definitely following along a lot of that. But you mentioned that in some ways we can think of the Milton Friedman quote of inflation always being everywhere.
Inflation is always and everywhere.
Always and everywhere.
One of my favorite quotes. Sorry to interrupt you, man. I just love that quote.
Absolutely. But that's exactly why I wanted to bring it up. Always and everywhere, a monetary phenomenon. So, in some ways, it seems like a lot of the inflation that we're seeing right now is due to, supply chain shortages, really from the supply side of things. So if we get enough demand destruction and that supply chain catches up, could we see inflation really end up coming back down here? What do you think about the considerations around that?
Yeah, we could. The supply chains have definitely been a part with the higher prices. Think about lumber. Lumber is really important for Canada. I remember last year, I don't know how much is up. You have the numbers, but it was a huge increase, parabolic increase in lumber. People were building additions to their houses. They couldn't go out on vacations. They're spending all their surplus money, their government checks, their stimulus checks, and like adding onto their house, refinishing a basement or redoing a bathroom or kitchen. And so lumber prices skyrocketed. Yet once that lumber demand kind of got through the system, they've gone back down, is my understanding. That's not a market I follow closely, so I don't have those numbers in my head. But, so I think a lot of supply chain things will be like that. But, inflation is general prices. There's a lot of focus on specific prices like lumber or even gasoline, but the general price level, and it's hard to imagine general prices going down. The rate of increase may slow, probably will slow if demand falls enough from the Fed raising interest rates high enough. But as far as like prices walking back, in a lot of markets, that's hard to see. Some specialized markets, maybe, semiconductors, RAM, stuff like that, prices rise and fall. But like if you're running a grocery store and you've got 2% profit margins and you hike your workers' pay because they can't survive, you're not going to go back to them and say, hey, we're getting better deals through our supply chain, so we're going to cut your pay 25%. I mean, people would freak out and leave. And so you have this wage price spiral thing going on where people are paid more because the prices are higher. And wages are so sticky. It's so hard to cut wages once you raise someone's salary or wages to a level to reflect the current price level. So I think the supply chain impact's not going to be as great through broad general inflation as people hope. I really hope I'm wrong on that.
Mm-hmm. So, looking at the particular charts that you've built of gold's performance during these rate hiking cycles, if we look at, let's say, the last two, for example, from around the 2005 rate hiking cycle, as well as the rate hiking cycle that started in late 2015, do you feel that the gold price really starts to react once the Fed pivots and starts bringing interest rates back down and or just pauses from the interest rate hiking?
The charts absolutely show that. That's back to that futures dynamic where if the dollar rises, the futures guys are more likely to sell because of their extreme leverage. And so there's absolutely in the charts where gold really seems to take off after the rate hike cycle's end. That earlier rate hike cycle you mentioned in the mid 2000s, that was a little bit different because gold was just starting into a new secular bear. It was just it was emerging out of a new secular bull. Excuse me. It was emerging from a long, deep, multi-decade secular bear, and so it's kind of just getting up to speed slowly. But there's definitely that phenomenon where gold tends to rally sharply after the rate hike cycles stop, after the Fed goes dovish, after traders can start pricing in Fed rate cuts. So yeah, that's absolutely in the data, without a doubt, Tom.
Mm-hmm. And I bring that up because we're specifically having a conversation about gold's performance in hiking cycles today. And, I want to kind of get your opinion on how we look at timelines. Obviously, you can cherry pick data from any point in time, and that all makes your comparisons relative, right? So how important is it to consider the timeline that you're thinking about these speculations or investments in?
Oh, timelines are everything. You buy low, sell high. And I see that all the time in my line of work, financial newsletters, trading. Like if you do a comparison, like if you compare gold and the stock markets, you can pick a favorable time where gold does well, the stock markets go poorly, or vice versa.
Mm-hmm.
On CNBC all the time, which is on back here all day, every day in my office, plus Bloomberg. They always talk about gold's performance, but it's cherry picked to be a time when gold was in a bear and stock markets are doing okay. So timelines are everything, without a doubt. And circling back, the reason I did this research is because so many of my subscribers were worried when the Fed was hiking rates. Should I sell my gold? Should I sell my gold stock? Should I be in cash? What should I do? And so that's why I did the research. It seems like more common knowledge that gold does well and the dollar does poorly when the Fed's cutting, or at least not hiking. Mm-hmm. So I was just curious how gold performed at the time when the futures guys think it's just going to get trashed or destroyed. And so that's how that research thread came. But timelines are everything, without a doubt.
Mm-hmm. So overall, when we consider all of the different, let's say, data points that you're looking at when we're considering these rate hiking cycles, do you feel like this is going to be a net positive in this hiking cycle for gold?
Yeah, I think it's going to be I think gold's going to rally huge during this rate hike cycle, Tom, without a doubt. One thing I don't think I mentioned yet is through all dozen modern rate hike cycles before today's 13th, from the first rate hike to the last rate hike, the very days, gold's average gains were 29.2%. Through the 8 rate hike cycles where gold actually rallied, 2/3 of those cycles, gold's average gain was 49.0%. I mean, these are big gains. And these cycles didn't last a ton of time because when the Fed hikes rates, the markets fall, the economy rolls over into recession. There's huge political pressure on the Fed to stop hiking rates. Mm-hmm. The politicians start talking about Fed independence, which drives the Fed guys crazy. They don't want more oversight from Congress. And so these rate hike cycles, I don't have the exact time, but might be around 14-month average duration, somewhere in there, a little over a year and a half, somewhere in there. And so gold has done amazingly well for these things on average. And I think this next one's going to be epic, Tom, just huge. I think gold has incredible potential here. We talked about the criteria that affects gold as far as whether gold can rally or not through a rate hike cycle. I think it's entering this one relatively low. And here's the reason why. Gold soared after that pandemic stock panic in mid-2020. You remember that. August 2020, it peaked over 2050. Mm-hmm. And that was a really exciting time. Great run. Gold stocks soared that summer. It was really fun. And then for the next 2 years, it corrected and then consolidated sideways. It corrected to the 1700s, low 1700s, 2 or 3 times. And it got as high as like 2050 again in March 2022 after Russia invaded Ukraine. There was a big spike in early March this year. But so at best, gold's consolidated sideways for the past 19 months or so. At worst, it's corrected and then rallied a little bit. So we're not entering this rate hike cycle at the end of a parabola. We didn't have like a 1980s scenario where gold shoots up 4 or 5 times in 6 months. And all of a sudden it's just crazy overbought. There's no buyers left in the entire planet. So we're entering this rate hike cycle relatively low technically, consolidation, correction, something like that. At best, gold's at a 19-month high, entering it, or near 19-month high. At worst, it's coming off of a correction and a mild bull so far. And the second thing, which we talked about a little bit earlier, Tom, is that this rate hike cycle is still relatively gradual despite being 50 basis point hikes every 6 weeks. Mm-hmm. We're talking 33, 35 basis points per month. Gold's average, those 8 rate hike cycles where gold won in the past, the average rate of the federal funds rate hikes was, I think, 69 basis points per month. So 35 is really low. Mm-hmm. And the average when gold lost the other 4 cycles, I think the Fed was hiking 124 basis points per month. So these are really slow hikes by historical standards, despite the 50 basis point thing being fast by the past couple decade standards. So from a pure rate hike cycle research standpoint, gold should rally in this one. But then, as you said, you add inflation on top, man. And then it gets really crazy. We mentioned those first 2 inflation super spikes, the last 2 back in the 1970s. Gold nearly triples during the first, more than quadruples in the second. And so I can't imagine gold at least not doubling through this cycle, Tom. It entered at about, say, 1700, 1750. So 3,500 to me seems ultra conservative for gold to end this inflation cycle at. I hate doing price predictions. It's just it's a recipe for disaster for an analyst, but I can't imagine gold not doubling to this with the money supply doubled, with the inflation raging, with the way it's set up entering this rate hike cycle. So I'm really bullish on gold during this hiking cycle.
Excellent, Adam. It's a great way to summarize all those points there. Earlier, you've mentioned a couple times, the two different words of investing or speculating. So how do you see the real difference between those two?
I think it's just a question of time. To me, a speculator is someone with a time horizon of 1 year or less. An investor is a time horizon of 1 year or more. Mm-hmm. I've seen that definition over the years and decades. I don't know if it's standard or not, but anyway, speculator is a shorter term trader and an investor is a longer term trader. To me, it's the only difference whatsoever is time horizon.
So, when we're thinking about something that you also mentioned earlier, the leverage that the paper gold contracts are traded with, you point out that a leveraged way to play gold's gains is to be invested in mid-tier and junior gold stocks. So what do you look for when you're choosing some of these types of plays?
That's my whole world is mid-tier and junior gold stocks. That's why I do this. I've been speculating in gold stocks for decades now. And, the mid-tiers and juniors, I define them based on their production levels. I define a junior as less than 300K ounces a year. And a lot of people have junior at 200K. I define mid-tier as between that junior level and 1 million ounces, which is where major starts. The number one thing I look for in gold stocks is production growth. I think that's what investors and speculators prize most, Tom. And the World Gold Council publishes these amazing documents quarterly called gold demand trends reports. And they summarize the world gold supply and demand situation from a global level. Great data, raw tonnages going into, investment, into central bank buying, into jewelry. But anyway, for a long time, it looks like we've hit a peak gold scenario around the world, where the gold mine supplies are drifting sideways to slightly shrinking. And gold is so hard to find. As you guys know, in Canada, it takes 10 to 15 years to find a gold deposit, to get the thing permitted, to get a mine constructed. It's such a long lead time business. The environmental considerations are so extreme now. And so supply cannot respond to gold prices for a long time, maybe 10 or 20 years on average. And so I look for production growth. That's the thing I like most. I like juniors and mid-tier stocks that are bringing new mines in line. Either they just have, or they're going to do it the next year or two. And so they're growing production. Growing production means lower costs usually, because the fixed costs of mining are spread across production. So the more ounces you produce, the lower the per ounce costs, meaning the higher the profitability. More profitability means bigger cash flows, which means you can build expansions for your existing mines, build new mines, buy their companies. And the majors have struggled with production growth for years. They see their mining production fall for a long time. Plus, they have market capitalizations that are too big to rally fast. It's kind of like the super tanker. If you got a super tanker steaming in the ocean, it takes a long time to turn that sucker or to stop it, because there's just so much kinetic energy. And so the smaller the market capitalization of gold miner, a producing gold stock, the more responsive it is to capital inflows from investors and speculators buying. So for me, man, production growth is everything. I also look at valuations. I like companies trading at cheap, trailing 12-month price to earnings ratios. I look at management. I look at what part of the world they're in, whether there have been geopolitical issues there. All kinds of things, cash flow, debt levels. It's really a comprehensive process, but production growth is the thing I prize most, without a doubt.
Mm-hmm. So with the cost of diesel, for example, eating into the margins of gold miners, is this bullish for the price of gold? Is it possible that we see higher cost miners stop producing gold because of this margin compression, and ultimately leading to less supply until the gold price starts to climb?
It is bullish. It is bearish for certain gold miners with high costs. It's gold miners don't shut down very often though. Every once in a while, they'll put a mine on care and maintenance, or they'll go to business, they'll sell themselves out. But, and there's a big gold stock constituency. It's because of that late 1970s, early 1980 gold spike. We all have kind of muscle memory of that, how awesome it was, how big the gains were. And so investors will invest in gold stocks a long time, even if they're not making good earnings from an accounting standpoint or a cash flow standpoint. But on the margin, eventually high cost should force out some producers. But on the other hand, high costs make gold go higher because there's less gold supplied, as you just said. And the higher the gold price goes, the more marginal deposits producers can produce other producers. Mm-hmm. Like gold deposits aren't homogeneous. Like they have different grades throughout the whole ore body, And so the mine managers can decide where they want to dig that ore, where they want to process that ore. So if gold prices are higher, they'll dig along the periphery of the deposits, and they'll run lower grade ore through their mills just because they can afford it. It's profitable. Mm-hmm. And so the relationship exists, as you said, but I think it's slow to react. I mean, we're talking 10 years to maybe decades to really play out like that, unless there's colossal price moves. So that's my perception of that.
Mm-hmm. So how do you see silver miners faring when compared to gold stocks here? Ultimately, there's fewer silver miners that, really specialize in that type of metal. So when we see momentum come back into the space, does that really supercharge the average silver miner?
Yes, it certainly should. I do a lot of silver stock research as well, own a lot of silver stocks. And one of the problems with silver is it's just gold has had superior economics for a long time now, over a decade for sure. And so a lot of the major silver miners, names that your listeners would know, names they've been investing in, they're yellowing, they're increasing their exploration focus, their new mine build focus to gold. And so every quarter I look at the percentage of revenues that all the major silver miners and even the mid-tier silver miners derive from actual silver production as a percent of quarterly sales. And even the leading silver ETFs, you're talking like maybe 35-40% of the revenues from silver of the top holdings. And so silver will be more responsive to higher gold prices. Silver stocks should be more responsive to silver, but they're mining more gold, which kind of complicates it a little bit. And so I like silver stocks. I think silver has more potential upside than gold because it's such a smaller market, back to the whole market cap thing. Mm-hmm. And, but the silver stocks, there are some primary silver producers, but they're getting rarer and rarer. And the more the revenues derive from gold, the more gold influences their price rather than silver. And so that's a concern I have with silver stocks, although I own a bunch of them. So,
mm-hmm. So Adam, we've talked a lot today about why you would be bullish on gold. So have you done any research around when you would want to really exit some of these, let's say either your mining positions or the actual physical metal positions that you might have taken?
Absolutely. I've been thinking about this for a long time. I like gold. I think it's the ultimate form of currency, but I wouldn't call myself a hardcore gold bug or gold zealot. I think it's a great asset to own when stock markets are overvalued. Like mm-hmm. the S&P 500 is trading at bubble valuations right now, defined as greater than 28 times earnings on a TTM PE basis. And so we have a secular stock bear overdue, Tom. The stock market should grind sideways or lower for, several years at least, and maybe sideways for a decade, 15 years, before valuations get back down to historically low levels, which is 7 times earnings. Mm-hmm. 14 times is fair value over the last century and a half or so. So one gold exit condition is if we get to the end of this bear, that the Fed rate hikes, the Fed tightening, the Fed quantitative tightening, the monetary destruction will likely eventually, impose on the markets. And valuations in the S&P 500 general stocks are down in the 7 to 10 times level. I'd probably consider dumping gold and gold stocks and buying the names everybody likes today, the Apples, the Googles, the industrial stocks, everything, just at super low valuations, looking for the next secular bull. The other thing I'd look for is a parabolic move in gold. And parabolas are never sustainable. We saw that in Bitcoin last year. We've seen it all throughout history. Silver a decade or so ago, gold back in the early 80s. And so if gold does something crazy, like goes up 3, 4, 5 times in 6 months, I'm exiting, period, full stop, just mm-hmm. waiting for a hard and fast correction. And so those are the two end conditions, really. The bottom of a secular stock bear in valuation terms, or a giant parabolic gold move that sucks in everybody. And, gold's like the most popular asset in the world, like it was back in, January 1980 type thing. That would cause me to exit.
Mm-hmm. Excellent. Well, Adam, I think that was a really interesting conversation, and thank you for giving us some perspective on gold's actual performance over these rate hiking cycles, which is where we find ourselves today. If you could give us a little rundown of what you offer at your website.
Well, thanks for having me, Tom. I really enjoyed our conversation this morning. It was great chatting about this stuff. Every investor needs to be aware of the inflation and how it's going to affect their investments. And everybody should have some allocation in gold. Don't have to be all in, but 5-10% in gold, double that in gold stocks. That'd really help people out. We have a website, zealllc.com. We publish weekly and monthly subscription newsletters just for people around the world. They're priced really conservatively, about $10 per issue, just so people can see what research we're doing and why. I also publish free weekly web essays available on our website, just with whatever I'm researching lately. So people should stop by zealllc.com if they'd like to learn more. Thank you so much, Tom. Really appreciate your time.
Thank you, Adam. Appreciate it. We'll talk again. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.